My very dear friend, Dr. Kelkar, Chairman of the Institute, Director, Dr. Rajendra Roy, Dr. Raja Chalaya's family, and distinguished friends. At the outset, I am very happy today to see such a gathering of friends and people whom I have known for 50 years, and apart from the people with whom I had to quarrel and work. So I think I can't conceal, but I don't know how to express my delight, my joy, my pleasure, and my happiness to see all my friends here. And I'm grateful to you, sir, Dr. Kelkar, for giving me this opportunity to meet and be with my friends. Dr. Chalaya combined in himself a popular teacher, a deep scholar, a builder of institution, a policymaker, and above all, a gentleman. I'm aware that in this gathering, there are several people to whom he has been a benefactor. We are fortunate that Dr. Chalaya built this world-class institution, one of the very few institutions in India that can claim an international stature. Fiscal and monetary policies are two pillars of macroeconomic policy, both for accelerating growth and ensuring stability. Their relative roles and the nature of interface have been of great interest to both academics and policymakers. But the narrative of academicians on the subject and policymakers may not be the same as that of the practitioners. And I quote from one of my colleagues in the RBI, from an article he wrote, quote, "Whereas theories raise fundamental questions about the functioning of the system and enunciate a model or behavioral laws under certain assumptions, practitioners generally rely on historical perspectives and experience as guideposts. Policies are more often based upon sound judgments and taking into account the economic milieu in combination with socio-political compulsions and circumstances. Therefore, policies evolve contextually to the particular environment. Naturally, policies cannot be understood or explained without reference to geographical location, historical context, and overall environment. I intend, therefore, presenting before you a practitioner's perspective of how the interface evolved in our country. I was on both sides, if not three sides of the game. I will briefly recall the pre-reform status of the interface from 1950 to 1991. Then this will be followed by a detailed account of the manner in which the interface between fiscal and monetary was transformed during 1991 to 2003. The transformation was through mutual consultations between government and RBI. This framework of interface was supplemented by unconventional measures between 2003 and 2008. It was put to test after the global financial crisis, something that was experienced in other countries as well. This stressful interface between 2008 and 2015 in India has been replaced by an entirely new framework in 2016. I propose to suggest that the new framework is in some ways a continuation of the past and new in some fundamental ways. The new framework is closer to theory than before and is closer to the practice being followed in advanced economies. Thus, there is a double convergence as far as the new framework is concerned. With the nationalization of banks, you had an interesting situation where the financial system got into the act, and then you had a joint family where you did not necessarily account for transactions. So then you have a banking system, then you have an RBI, and then you have a government. And and at the same time, developmental loans were floated. And I must share a couple of experiences here. In 1967, as sub-collector Ongole, I was asked to collect money informally by the government, informally, from people, rice millers, ration shops, etc. because we have to subsidize the government borrowing program. The government bonds have to be issued development loans, yes, the government loans. So having artificial low interest rates for government bonds is not new. In 1967, unofficially, the receipts were issued, but it is unofficial. The money there. So we hand over the subsidized amount to select people who buy the bonds because the market rate was that. Okay. So we lived through that. And then we come to 1972-73, after the nationalization of banks. It's not as though we resisted, especially after 69. Then we had every state was encouraged to have a commissioner for institutional finance, because the development had to be funded government plus the institutions. And the institutions again meant bank or development finance. So the whole approach was that you blew, and this was nothing, I mean, not that there was any resistance, because everybody thought that's a good thing to do. That's what we're doing. So this sort of thing went on up to 1980. And as we approached 1980, the basic problem the basic task of RBI was to control the damage. This is uncontrolled expansion, they can only try to control. But 1991, there was a paradigm shift in the interface as part of the reform, which commenced in 1991. At a very broad level, the paradigm shift occurred through a series, I would say, of acts of abnegation of power by the government to RBI and the markets. I think this is the significance. The power was concentrated. In these 12 years, 91 to 2003, the power was surrendered virtually through mutual consultations to the RBI and to the markets. And how it is done is very important, because it is as much as management, administration, economics, and politics. Now, what did we do actually in substance? First, there was an end to the automatic monetization of government deficits. Second, fiscal rules were put in place through the enactment of fiscal responsibility legislation. All this happened, it took 12 years, but this is a fundamental shift. The exit from the financial repression commenced. This SLR, CRR started bringing down. Fourth, a decision was taken to eliminate, at least try at eliminating. Fifthly, providing refinance by RBI to various entities was gradually phased out. The idea was whatever money is to be created, we'll create. If necessary, we'll give it to the government. And you give it to them, but we don't have two sources. Finally, the policy, sixthly, the policy of transfer of profits to the government from the Reserve Bank of India out of the surplus was rationalized and made formula-based. Finally, the separation of debt office from the RBI was proposed by the Reserve Bank of India, subject to fulfillment of preconditions. Of course, many of these reforms are still in progress, a little slow progress after 2003, if I may submit. I moved to the Reserve Bank of India from Ministry of Finance in 1996. In due course, it was decided mutually. Earlier, the RBI itself used to buy the bonds and the primary issuance itself. So actually, you are also in the market buying the bonds. You are the debt manager. That was the practice, because otherwise you couldn't raise the money. You just couldn't raise the money. So then we said, no, we won't do involve as primary issues. We'll do only secondary. No, but how do you sell? Because there's no. So we had to create primary dealers, give them the money, and make them buy this. So, but at least slowly you have to bring into marketization an extremely unviable situation. So this is how we provided money to the primary dealers, gave them special treatment, etc. Not unheard of in the world, but we had to do that. Then the most important thing is that all this was done without legal provisions. This is all settled, practiced, and after that we said, okay, now let us put it into law. Because one thing I always believed is that law enables some things, law prohibits some things, but most of the good things can be done without reference to law. So in fact, that's my standard. 90% of the economic reforms do not require legal changes. And I can prove separately if I'm asked to write a book. Now, so what we did, we wanted to bring it into a law. Now, how do you bring it? The government was keen on FRBM. So if you are keen on FRBM, you put this in. So normally the restriction on the financing of the government by the RBI is a prohibition put on RBI in the RBI Act. In India, you will find it in the FRBM Act, where the government says, you don't finance me, okay? So that is the law which you find here in the FRBM. Okay. Now, having done that, we had also looked at the balance sheet. The balance sheet became important because once you have this whole system. Now, the balance sheet again had two problems. I'm going into detail because this is the way the interface works. See, there are two problems. One is the legacy problem, the other the future. The legacy problem is we had, I think, 170,000 crores or something in those days of treasury bills. That means 4.5% interest rate. Market interest is 8%, no maturity. So once we went to the auditor and said, we must clean up the balance sheet. I said, okay, you can do that, mark to market. So loss is 80,000 crores, ask the government to give you. Oh. So there's no way. So the way we did it is then we got into an agreement and I said that, look, we will convert these ad-hoc treasury bills into marketable securities. That means the interest rate is higher. But I am holding it, so whatever interest you pay me, you will get me back as profit. So I'll make a separate account for it, I'll give it back to you. The advantage is whenever the market opens, I can sell this. And this helped us in operations years later when I got the capital flows. And we perhaps were the only country we could absorb 10% of GDP of capital flows in 1 year. Incidentally, the issue of transfer of surpluses to reserves. So the criteria, we worked on a criteria, we got global experience, and then we said, what's our circumstance? I had a committee, put it in public domain. Under law, board of RBI has to approve. How much is required for the reserves? They take it to the reserves, and the rest goes to the government. That is the law. It's the board which decides. But anyway, we said that it should be policy. And then the auditors also agreed. We went to the board. But as usual, before I go to the board, I get the blessings of the government of India. So I went to government of India, we explained. And then every time the query was coming, so finally I went back and I said, in fact, Montek was there, so I tried to explain. And after some time, he was a little tired, money supply. So Montek said, Arey Venu, tell me, if you were finance secretary, will you agree? I said, yes. And that's how it was agreed. So we have I'm not joking. And that's a trust. The whole point was there was a formula. It was based, it was analyzed. And so that's how we arrived at the formula at that point of time, which has been operating for almost 20 years. Now, then came the question of, incidentally, there is another subject which is current, recapitalization of banks. So that was another funny legacy problem. Government of India at that time had to recapitalize banks, and they had to recapitalize banks without increasing the fiscal deficit. So how do you do that? So the government of India went on giving the equity to the banks and asked the banks to buy bonds. And bonds, some rate was fixed, some maturity was fixed through bilateral negotiation. And the banks also were told that we'll repay when we want to, so it's not marketable. So that was the arrangement. That was how they recapitalized. Now, my problem was that, see, this is not the way you run a modern system. So how do you ensure? So we negotiated and told the banks that, look, we will get converted into marketable securities. And the government will have to pay higher interest when it's due. But we said from time to time. So over a period, we got rid of all these distorted, privately placed recapitalization bonds into the banks. They became marketable securities. So in fact, in a way, the supply of government securities was increasing, which we wanted to develop. If you wanted to develop, you require money markets and government securities. Because most important, fiscal policy and what's it? Monetary policy. Fiscal policy, monetary policy interface occurs through financial sector. And I think that's the critical part. Otherwise, the interface in the market economy depends on the way your financial sector works, and I'll come back to it later. Main point I want to make is the interface. The interface between fiscal and monetary policy is essentially a political economy issue. Fiscal policy always has gainers and losers. Monetary policy has gainers and losers. So this interface itself is a political economy issue. And the extent to which it should be apolitical, what the extent to which this interface should be apolitical is itself a political economy issue. So technocrats like us can only facilitate, can promote, can sell, but we can't make it happen. I think that's the thing I just want to mention before I go to the next stage. Having done this, we thought that now we have settled the matter, we've got an ideal framework, legacy problems sorted out, and then what happens? And then in the meantime, what we did, I came back as governor. So I thought, now Kushi hai, but the problem is, we got an unanticipated problem. No interface framework could anticipate that we'll be getting too much money. And that started coming. So then we had a situation, what do we do? So we decided on two things. One, the framework inherently is good enough, and therefore all the proposals which are already pending about the RBI, amendments to RBI Act, amendments to BR Act, to formalize, to legalize the practices should be continued, and they are all done. And then we produce, quote unquote, some unconventional measures to take care of this unanticipated problem, which we did not expect to last forever. It is a temporary problem, maybe 2 years, maybe 3 years. We require unconventional measures, we should do that. So that was the strategy, it's a parallel strategy. The fundamental framework, we didn't want to disturb. Now what did we do? Then when the normal process of shifting to indirect instruments, namely liquidity adjustment facility, we completed it, we went through. But we introduced the market stabilization scheme. So basically under the scheme, the operational autonomy of RBI, that we said, we went to the government and said that, look, up to a point, that is, the liquidity adjustment facility is for operational purposes. If there is excess capital flows, it's huge liquidity. So we tried to make a distinction between normal liquidity and extraordinary. I said, normal is something which RBI can handle. Extraordinary is something that I can't handle, let the sovereign handle. So when this was put up proposal to the government, and I wanted the government to say that you tell me how much is the ceiling. I will operate on your account how much. So you borrow money and don't use it. That's what I do for sterilization. But you do it on your account so that you know the pain of capital account liberalization. You want more capital, then you pay for it. Unless you are prepared to allow the exchange rate to. So this is the only way I could handle it. And naturally, first round the government rejected on the advice of the chief economic advisor. So then I was told that this erodes the autonomy and independence. I said, I don't want independence. I don't want autonomy. Please, you don't give me the autonomy. And therefore, it was approved. And so every time the ceiling had to be approved. This was unique. Now I'll quote from a Currency and Finance report of 2013, RBI Currency and Finance report, and I'll quote. A large number of countries such as Chile, China, Colombia, Indonesia, Korea, Malaysia, Peru, Philippines, Russia, Sri Lanka, Taiwan, and Thailand have issued central bank securities. However, the central banks of many of these countries faced deterioration in their balance sheets. What happens when your balance sheet deteriorates? You go to the government and beg. So instead of going to beg when I am weak, I go to started begging even before I became weak, okay? As simple as that. So as such, the MSS consider, it continues. However, the central banks of many of these countries face deterioration in their balance sheets. As such, the MSS considerably enhanced the degree of freedom for monetary policy. It strengthened the Reserve Bank's ability to conduct exchange rate monetary management operations. It also enabled the Reserve Bank to use the MSS tool flexibly to both absorb and impart liquidity later. After the global crisis, these MSS were unknown. This is the countercyclical weapon which was created jointly and not independently. Now let me come to the global crisis and stress. The global crisis, no, that's a different ballgame. Fortunately, I handed over in 2 weeks in advance of the global crisis. The global crisis compelled coordinated fiscal monetary actions in all countries. And in India was no exception. It had to be done. And this is again, but the problem is there's a stress now. There's a stress in the sense that when there's a problem and everybody wants liquidity, financial markets want liquidity, government wants liquidity, RBI gives liquidity, then everybody is happy. Full coordination within the country, among the countries, G20, everything fine. But it breaks down for two reasons, which was to be expected. When there is uneven recovery in different countries because uneven initial conditions, then there cannot be synchronized exit. First problem. The second and more important problem is in the coordination within the country, it's always there is a resistance in one, as you know, in one business cycle, there's resistance in another, they are happy, and that's what here also. the central bank, as you know, would like to exit at a particular point of time, and usually the perception, the government is, no, it's not necessary to exit now. And so, nothing very unusual in our country also, first coordinated response, later uncoordinated response. So, and then you get into this problem. So, but here in India, these developments led to questioning the monetary policy framework itself that was in place. So this, in my view, was a natural stress, but still that was questioned. And finally, there's a new framework. And now let me come to the new framework. The conduct of monetary policy in India showed therefore a transformation in 2014, transiting to flexible inflation targeting framework. So during 2014-15, I think a formal architecture for flexible inflation targeting came. I don't have to explain. You are more up to date than this. I'm retired. But the main thing is the primary objective was defined as price stability. That's a primary objective. The RBI Act was amended. Then there's inflation. So one objective, primary. Second, inflation targeting. And third is the interest rate. Is the instrument. So that's basically the architecture. And the Monetary Policy Committee will have representatives of the government. So this is what I may call the new formal fiscal and monetary framework for the interface in India provides greater clarity than ever before on the respective roles of monetary and fiscal authorities. We emphasized the coordination of policies in view of the structural transformation underway in our country and complexities in our economic system. Our instrument was not confined to interest rate, though gradually it became the primary instrument. We did not hesitate to use several instruments, namely direct and indirect instruments, as well as regulatory actions. The reform process and the policy actions to meet immediate challenges were coordinated, resulting in multiple objectives with a focus on price and financial stability. Multiple instruments were used to assure price and financial stability, and these were not restricted to monetary policy instruments. So the global consensus, which was reinforced at that time, but what was called a great moderation, prevailed till the onset of the global financial crisis. This is the wisdom that prevailed. After the experience of the global financial crisis, there was a slight change. Inflation targeting approach was diluted to make it flexible. The single objective was supplemented with consideration of financial stability. Independence of central banks is now subject to orientation in favor of coordination with other agencies, in particular government. So there's a slight nuance that has happened at the global level. The new framework adopted by India shows convergence with the current global consensus. And the current global consensus is not the purest now, it's slightly diluted, and on the interface. So I'm not referring to the relative emphasis between fiscal and monetary, on which the matter is yet to be resolved over there. But the issue of framework is what I was referring to. So we are closer. India is now closer to the global consensus. There is also a convergence of RBI framework with practices of other countries. Actually, if you say number of countries, and as an annual report of RBI itself says, we are now in the group of many countries, advanced economies. So in that there is double convergence as far as our framework is concerned. So if that comes, what is the stand of India? Has China benefited by doing whatever it did, becoming an SDR? So this is something which at some stage I had discussed informally. I'm myself not sure, but I think this is something, and this has a lot of implications for our monetary and fiscal management. So this is one thing which I want to say looking ahead. You may have to analyze how these global developments will impact, because relative importance will have to increase as we move along. The financial system. The financial system is critical to the interface between fiscal and monetary policy, as I mentioned. India is a bank-dominated economy, and in the short to medium term, this is unlikely to change. Transmission of monetary policy depends on banks, and in particular on their ownership and governance structures and functioning. That's a fundamental basis on which all the policy decisions are taken. Now here, such an assumption in the conduct of monetary policy that the regulated entities would respond to market signals may not be very realistic. And then you do not know what assumptions to make. So that's the problem. From the public sector bank's point of view, there are serious problems. So much SLR, CRR, priority sector lending, and then other lending, etc., etc. Now, the common thread in Indian situation, for many reasons, the common thread between fiscal policy, monetary policy, and financial sector is public sector banks. That is the common thread. Nothing can be effective. In fact, even a tax from public sector banks, both service and corporate tax, will see it's huge. So the future of the financial system, and indeed modernization of financial sector of India, depends on how we overcome the intractable problem of the public sector banks. I don't know how to call it, intractable or something like that. Okay. But there seems to be a political economic consensus. There's a political economic consensus that as far as possible, don't do anything about public sector banks. So that is the problem. In my view, the future of the modernization of the financial sector, and therefore a modern economy, will depend on the way the public sector banks issue is sorted out. A critical input in the fiscal monetary policy interface is the assumptions regarding the fiscal deficit. So here the point is, normally the Reserve Bank of India makes its own assessment of the likely fiscal path. So there is a budget announcement, and always the governor has to say, yes, we believe that's correct, it's correct. And then, but you make your own assumptions. That's called, I call it assessment. This is an assumption, that's an assessment. So now, I'm sure that in the MPC, they will be making an assessment as it was before. I'm sure they do that. Now, then the uncertainty regarding transfer of surplus is a very important link because it has something to do with the independence of the central bank. That still persists. Technically, it is possible to take the stand that a central bank need not worry about capital in much as the government would always recapitulate it. But basically, it's better. You can take everything or you can have a principle. So these are the concluding remarks. Traditionally, the debate in the context of monetary policy has been a choice between rule versus discretion, committee versus individual, targeting versus non-targeting, and independence versus coordination. The global financial crisis has shown that the reality is more nuanced, and reality is that of balance. The buzzwords now are constrained discretion, flexible rules, and flexible inflation targeting. Similarly, there is an increasing emphasis on coordination along with independence. Increasingly, monetary policy is becoming more of an art, even if it is not less of a science. Let me conclude with a word of optimism. All the members nominated to the Monetary Policy Committee of the Reserve Bank are economists with impeccable integrity, professional credentials, and a reputation for independent thinking. I could not have picked a better team. We are in very safe hands. Thank you very much.